Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Scott Nations, President of Nations Indexes, and Mark Sebastian, CEO of Option Pit. We're here to discuss what it means when the 10 largest names in the S&P are showing net call skew. Scott, that's an interesting point that you had noted, and I know this isn't the most technical term, but it feels as if the market's behaving a little bit weird today and last week.
It is, and we have talked before about a substantial amount of complacency in the market. And what do we mean by that, Jill? It's just that option prices are very low as the S&P and the Nasdaq 100 have started to make new all-time highs. And, when the market's going along well, you expect there to be some complacency. You expect there to be bullishness and people are not particularly worried to the downside. But we're getting ahead of ourselves here in that traders are really starting to reach for call options, out of the money call options in some of these biggest names. And so the 10 biggest names in the S&P are now showing what we call call skew, meaning out of the money call options are more expensive than protective out of the money put options. And even if you look at the broader S&P 500, protective downside put options are very inexpensive historically. And that has to worry you a little bit. We're seeing that come undone a little bit. Implied volatility and option prices are higher this morning. Some of that has to do with the regular Monday effect. Some of it has to do with the not so regular Monday effect, and given what happened over the weekend. But still, option prices are relatively low, and there's just not very much fear.
Yeah, Mark, you would think that options traders would be looking to pick up some protection here while it's still relatively cheap. But back to Scott's point about what we saw in Pennsylvania over the weekend, it seems to be as if the market is digesting some of the things that we're seeing coming out of the political sphere quite well. I mean, even following the debate and then the last speaking engagement President Biden had, and of course the attempted assassination with Trump over the weekend, seems to be as if it's not being considered a major volatile event.
Well, yeah, I mean, I don't think it's going to end up being a major volatility event, what happened over the weekend, but we may be kind of slow walking into a volatility event. One of the things that has really been troublesome is how narrow the rally has become. That's part of the reason why that call skew is getting so expensive in names like NVIDIA and Apple and Amazon and Google, is because everybody is buying those 10 stocks. It wasn't until really Wednesday that we've seen the rest of the market rally. And what do I mean by that? So if you look at equal weighted S&P, that is, imagine, to make it simple, imagine I put $100 in every single stock in the S&P 500. That's equal weight. The S&P 500 that you look at, the one we quote, that is cap weighted, as is the triple Qs. Those are cap weighted, which means the more expensive the stock is, the more valuable the stock is, the more weight it has in the index. Up until Wednesday, if you had bought equal weighted S&P 3 months prior, you were down. And this is with the S&P hitting all-time highs. And that's because this rally had been so narrow. It had just been in really the big 8 names, Apple, Amazon, Broadcom, Google, NVIDIA, Tesla, and Microsoft and Meta. Those are your 8 names that have really driven this market. Last Thursday was the first time in months that those names all sold off at the same time. But interestingly, money didn't really leave the market. If you looked at breadth, the market was up as a whole. Money was selling out of the big names and buying into the rest of the market. And we see that continuing today as we see strength in the Russell 2000 and in equal weight, while the S&P and the Nasdaq have kind of pulled back from the morning session highs.
Right. Well, Scott, wouldn't you consider that encouraging if we're seeing not money necessarily being pulled out of the market, but it's rotating to other places? I mean, for months now, people have been looking for a sign where there are other attractive areas, particularly in the small caps. The small caps haven't participated at all.
Yeah, I think Mark has really put his finger on the important point here if you're worried about this market, because when the entire S&P is relying on just a few names, that makes it very vulnerable. Yes, those are the biggest names, but if something unexpected happens, and we now see that that's certainly possible, then investors and traders are likely to sell those names that are up the most for the year, the biggest, and the ones that they think are the most liquid. And those are the biggest names in the S&P. And so those could really take it on the chin if we saw something really unfortunate, either geopolitically or politically. And so that's another reason that I think that the market has been vulnerable. But Mark points out appropriately that that is also starting to come undone a little bit, in that S&P equal weight is starting to gain on the cap weighted version, the headline version. And that's really good news for the average investor.
Yeah, but I guess what my question is, when we're thinking about potential black swan events, I mean, the attempted assassination on a United States president, you would think that, I mean, it wasn't really even a blip in the market. What else can be, I guess, more contagion than that is my question.
Well, I think if they'd been successful, we'd be having a very different conversation.
Right, that's a good
The
point.
fact that it was just an attempt and was not didn't come to fruition, that's why the market was able to move on quickly. I continue to think that interest rates are the gorilla in the room that nobody is talking about, and there continues to be some risk there. The market kind of got what it wanted with CPI on Wednesday, and that kind of marked the top for those big 8 names and this flow into the rest of the market. Now, what I worry about is that people get spooked by interest rates, and we see maybe money actually leave the market. And what we would see is those big 8 names being sold, and maybe not your Johnson and Johnsons and 3Ms and Union Pacifics, but maybe the money doesn't flow back into buying those. We see that. We could see the S&P pull back 5% in a snap. And that's really where I think there's still a lot of risk in the market, is that we get selling in the big 8 names, and maybe that money just sits on the sidelines for a little bit.
Yeah, I mean, 5%, that was 5%. I mean, we really haven't had a substantial move for the most part, right?
We haven't had a substantial move in almost a year. It's been, what, 345 days or so since we've had a 2% down day. The last time we had a streak like that was in 2000, in 1999 and 2000. So that's kind of where the market is. And to Scott's point, I believe this thing does feel very toppy right here, especially in those concentrated names of the great 8, if you will.
Right. Well, Scott, I think the bigger question is, if you were to, get, let's call it 25 or even 50 basis point rate cut, and that is the catalyst to potentially a sell the news kind of event that Mark is suggesting. It seems as if the market underlying is a little bit more weaker than suggested, if it can't digest something that is anticipatory.
Yes. Also, we've gotten into a situation where realized volatility in the market. And when we talk about option prices, we're talking about implied volatility. How expensive do we think the market, how volatile do we think the market's going to be in the near future? But realized volatility, how much it's actually bounced around over the last 20 trading days has been remarkably low. And so that's another reason that I think people are a little complacent. But you're absolutely right, Jill, in that if we get 25 basis points in not the July meeting, that really seems unlikely according to the market, but in the meeting after that, and then the Fed says, well, you know what? You guys got 25. We've started cutting, but we're going to hold off now and see what happens. The market could be very disappointed by that sort of patience on the part of the Federal Reserve. And that could be really unfortunate if people are pinning their hopes on 75 basis points by the end of the year.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.